Welcome back to the channel. Today we're diving deep into the upcoming changes for the Schwab U.S. Dividend Equity ETF, or SCHD, during its 2026 annual reconstitution. If you're a long-term dividend investor, or even just curious about how ETFs like SCHD evolve over time, this video is for you. We're going to break down everything from sector shifts to dividend stability and what it all means for you heading into 2026. Every March, SCHD undergoes its annual reconstitution. This is one of the reasons why many investors love it. It's a rule-based ETF. That means the fund doesn't rely on opinions, speculation, or hype. Instead, it strictly follows a defined set of criteria to determine which companies stay in the portfolio and which ones are removed. If a company no longer meets the dividend or quality standards set by SCHD, it simply doesn't make the cut. Conversely, new companies that meet these standards are added, and the weightings of existing companies are adjusted based on their fundamentals. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Think of it as a once-a-year portfolio reset. While other ETFs like the S&P 500 focused funds might rebalance twice a year, SCHD takes a more measured approach. Once a year in March, it realigns itself, addressing risk, dividend sustainability, and performance potential for the year ahead. Analysts currently rate SCHD as a hold. This means it's not considered a buy, and it's not considered a sell. It's neutral. But let's be clear, neutral doesn't mean there's anything wrong with SCHD. Far from it. The ETF is still performing well, with a dividend yield hovering around 3.7 to 3.8%. Which is solid for a mature dividend fund. That said, the changes coming this year aren't expected to create a massive tailwind. We aren't talking about a complete overhaul. This is the kind of fund that evolves gradually. The key story here is understanding where the shift is occurring and how it impacts your portfolio. One of the most significant changes expected involves SCHD's energy sector exposure. Currently, energy accounts for roughly 20% of the ETF. For some investors, that's a lot of exposure to a sector that can be highly volatile and cyclical. After the reconstitution, the model predicts energy's share could drop to around 12%. Why? Some of the larger energy companies, including refiners and oil service firms, no longer meet SCHD's dividend consistency or quality standards. This reduction in energy exposure lowers overall portfolio risk, but may also slightly reduce yield. So, as always, there's a trade-off between stability and income potential. Meanwhile, financial companies are projected to gain weight in the portfolio. Banks and insurers could add around 4% to 5% collectively. Financials often score well in dividend sustainability, profitability, and balance sheet strength. If interest rates continue to drop and borrowing costs decline, banks could benefit significantly. Lower rates allow them to refinance mortgages, lend more efficiently, and generate predictable cash flows. While less flashy than the energy sector, financials offer the kind of consistency that many SCHD investors value: steady earnings, steady dividends, and less exposure to commodity cycles. Now let's touch on how SCHD evaluates quality, because this is central to understanding why these sector shifts are happening. The fund uses return on equity, or ROE, as a primary screening metric. ROE helps identify companies that efficiently generate profits relative to shareholder equity. For financials in particular, ROE can favor companies that use leverage effectively. Alternative measures like return on total capital exist, but SCHD relies heavily on ROE to maintain its standard of quality. This approach directly affects which companies are added and removed during reconstitution, and explains the changes in sector weightings we're seeing over time. Historically, some SCHD holdings have experienced negative annualized EPS growth. That's never ideal, and it has prompted some investors to reduce or exit their positions. Remember, dividends don't come from vibes or popularity. They come from earnings. The reconstitution is designed to improve earnings durability and strengthen long-term dividend coverage. That's another reason financials may replace some of the energy exposure. So, what does this mean in practical terms? If you're a long-term SCHD holder, this is business as usual. The reconstitution is part of the fund's natural evolution. You shouldn't panic or react impulsively. For income-focused investors, the expected 3.7% to 3.8% yield may fluctuate slightly. Volatility might drop a bit, and the portfolio may become more balanced overall. If you want energy exposure, you can supplement it elsewhere, but the fund itself is aiming for more predictable returns and steadier income streams going forward. The big takeaway here is that SCHD is evolving, but it's not deteriorating. It remains a high-quality dividend ETF. The annual reconstitution helps manage risk, maintain consistency, and align the portfolio with its core strategy. Investing in companies that reliably pay dividends, maintain quality, and deliver steady returns over time. To wrap things up, the SCHD annual reconstitution is a normal and healthy part of how this ETF operates. Energy exposure is likely to decrease, financials are expected to increase, and the fund's focus on quality and dividend sustainability remains strong. For long-term investors, this is about consistency over excitement. Stable income, less risk, and reliable companies forming the backbone of the portfolio. So whether you're already invested in SCHD or considering adding it to your portfolio, remember, this isn't a moment to panic. It's a moment to understand the rules, appreciate the strategy, and plan for steady, long-term growth. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.